The stock market gives you what you want. As the very renowned and successful trader Ed Seykota says, win or lose, everybody gets what they want out of the market. Some people like to lose, so they win by losing money. But when you ask too much from the market all at once, that is when you get nothing. And a lot of people come as investors in the market, but then they do more than just investing and then get nothing. A lot of my investor friends have made the same mistake in the past, and today I'll tell you what that mistake is and how you can avoid making it in the future. Let's get started. Have you heard the story of Icarus and his wings of wax? You must have probably heard that story multiple times when you were young, but let me tell it to you again quickly just in case if you must have forgotten. So basically, Icarus has wings of wax which were created by his father to escape some place. Now his father warned him about not flying too close to the sun as his wings would melt, but Icarus became too overconfident about his wings. He flew too close to the sun, because of which his wings melted and he fell to his death.
Oh my god, bro. Oh, hell no.
And in today's time, the same type of people, aka the modern Icaruses, are present in plenty in the stock market. When we finally start to get a little right and make some money in the market, we think we finally made it. We think we've cracked the code of the market and we are the almighty operators who know every single move that is going to come in the future. And this happens with both traders who make short-term bets and investors who make long-term bets. For traders, it's pretty easy to understand how this could happen. But how could this happen for investors? You see, when investors start to see gains on their investments, they think this is because of their intelligence. And sure, that might be the case, but most of the time it is just that the market conditions are easy. And they might be in one hell of a bull market where every trash stock goes up 20% every month. When their gains start to increase, that's when investors start to think that they know how the price action works in the market and that they can gauge exactly how the stock will move in the future. And this is where things start to go sideways. When an investor is investing, he should not become a trader, and when a trader is trading, he should not become an investor, because both of those things are very different and require very different mindsets. But novice investors don't care about this, and so they start trading with their investments. But how? Let's understand with an example. When a stock goes up from 100 to 130 in a single month, a novice investor will think, let me exit my investments over here. The stock is already up 30% in a single month. I'll wait for a pullback and then enter at lower levels again. But the stock never goes lower and continues its up move, going from 130 to 135, 135 to 140, 145 and so on. Then the investor thinks, okay, the stock is not stopping. Let me enter over here at 145 again before it is too late. And as soon as he enters at 145, the stock takes a pullback and goes back to 135. Now here's where the novice investor panics and exits his investment, thinking that the rally is finally over and the stock will not go up anymore. But soon after, the stock continues its up move and reaches 150. But our novice investor is just left on the sidelines. Now if the investor would have just done a simple job of buying the shares at 100 and holding them, he would have had a profit of $50 on each share. But since he decided to use his brain too much, he just now has a profit of $20 per share. And that is what kills many people's investment gains. They try to be a trader when they are supposed to be an investor. Look, I'm not saying that timing is not important or that you should not book your profits. You should. But when your investment reaches at that point, when the stock is actually overvalued, when the growth potential has finally been factored into the stock's price, and not when the stock has run up too much in a short span of time and so you think it is bound for a correction. That's just not how it works. The job of an investor is not to avoid or capture every single dip. It is to sit through them once they are invested in the stock and only exit when the fundamentals tell them to do so. Many new traders today have a lot of excitement and restlessness in them, and so they find every single reason to trade again and again in the market. But sometimes the best thing to do is just to let your winners run and cut short your losses. Don't run for every single point of profit, or else you might lose the ones you already have. See ya in another one.